the most important thing I think right now is we're talking about, it's getting a lot of attention finally. I mean, after this huge rally, a few firms finally upgraded the group last week, but after 90 to 110% rally, so it's starting to pull back a little bit here. That because it was getting overbought, and that's normal and healthy. But the point is, as he said, it was very, very underloved. Even though people are starting to talk about it now, it's still very underowned by the institutional community. I mean, these companies, I'm sorry, these investors, these institutional investors, they own huge portions still of the Apples and the Amazons and some of these other FANGs. Apple and Amazon are great, great companies, and I can see why you love them long term and why you're going to hold on to a big chunk of them. But if you're an institutional investor, you're still gauged every single year. Okay, the S&P 500 is up just about 10% so far this year. The S&P Energy Index is up 40%. And the tech index is up only 4%. So not only is it badly underperforming the energy stocks, it's badly underperforming the market. At some point, these people are going to have to have no choice, because they get measured every single year, to sell more of these big cap tech names and go into the energy, because that's where the performance is. And what I'm really looking at now is
I mean, think about what you're saying. It's pretty much amazing. And let's take ESG out of it, because we understand that a lot of the university endowments, right, they're not going to own fossil fuels because students complain. We get that. Let's set them into their own basket. What you're saying is that for traditional fund managers looking at their performance, they need to look good. They need to have winners on their books. The winners this year are not Apple and Amazon. They're not the FANG stocks. They're FANG, Diamondback Energy. That's its ticker. You say that because it is so under-owned, institutional managers may have to pile into it so they can show, look, we also own Chevron.
Exactly, and it's they're going to have percentage move, and again, you're looking at what's going to help you move higher. When a group is still incredibly underowned, that can help. That can still has a lot more to go on the upside. So therefore, they don't mind piling into a group like this. It's like saying, some people I've heard the last week saying it's getting to be a crowded trade. I'm like, no, it's getting more popular with people talking about it, but it took years for it for the energy. I'm sorry, for the tech stocks to become so incredibly overowned. It's going to take a long time before the energy group even becomes owned on a market weighted basis. And the thing is too is that people are saying, well, so fossil fuels are a thing of the past. That's fine, but they're not going away in the next few years. It's going to take a couple of decades. So you can still, it's just the whole thing between Bitcoin and gold. I mean, you can still make money in both, and people are right now are going to have to focus on these energy stocks and gold and other commodities going forward if they want to perform and keep their jobs and get their big bonuses.
Yeah, and I don't want to put you on the spot, Matt, but Bank of America had a mutual fund manager survey a couple of days ago. I don't know if you saw it. If you didn't, I'll recap it because it doesn't matter. You can comment on it regardless. They asked a couple questions. They asked all their fund managers, a huge survey, right? They said, what are the most crowded trades? Well, the first most crowded trade, according to fund managers, was long Bitcoin. The second was long ESG, right? Companies say, oh, we make bleach and deadly chemicals, but we're still ESG because we bought carbon credits. Then they also asked where they saw gains. And gains in oil was like the top of the list. So you're thinking long ESG is overcrowded, according to fund managers. Oil may have its way up. It appears that there is some investor and technical momentum behind the XLE, the XOP, and some of these other ETFs.
Yeah, and the point is that when you get a situation where people are talking about it, it's like, what do you see going forward? It's one thing is like, what's the most crowded trade? Then that's a contrary indicator, but when you see a situation where they're saying what has the most upside potential, they look down at their portfolios and say, well, oil is up a lot, and I don't own much of it. And so that's when they're looking more in the future, and that's when it's a good indicator rather than a contrarian indicator. And the thing to look right now is at $66 at WTI. Yeah. Not only is that the highest from this year, but it's the highs going all the way back to 2019. It would be a 4 or 5 year high. It's pulling back a little bit. It breaks out there. These people are the momentum's going to take it even higher. And again, it's going to force these institutional money managers to, again, rotate more towards the group. And there's a lot of money that can still go into it.
Shepard Smith here. Thanks for watching CNBC on YouTube.